Tomas, we are back, my friend. You know what that means. Time for a little bit more Tasty Live with this. Let me explain, Mr. Chris Vecchio. Welcome to the show.
Good to see you guys again.
Good to see you.
Welcome back, my friends, to the show that never ends.
I got a tongue lashing from Dylan yesterday because he said he couldn't believe that me, who grew up in colonial Northeast America, has been hunting before. His delicate sensibilities were offended that we discussed this on Sunday night.
That you went hunting, or that he's been hunting?
Oh, that I went hunting. He thought I was some effete liberal. It kind of took him aback.
Well, I mean, you know, I'm surprised you went hunting too. We not actually. Nobody here believes it. We think you just kind of made it up because Italians,
Sure.
You know, I mean,
Italians have been hunters for many generations.
really, what kind of hunters?
Good ones.
Yeah, I did. Obviously, you haven't seen my cousin.
For truffles. With
You haven't hunted. You haven't seen my cousin Vinny.
dogs.
You haven't seen my cousin Vinny either. No, Italians are not hunters.
We are hunters.
No.
Tom, our founding myth: we were raised among the wolves.
Oh, please.
That's how Rome was started.
Oh, please.
Right.
Please.
Conquerors. We weren't just sitting there.
Conquerors. Now you're
kibbutz
conquerors.
somewhere, you know, like up in the
kibbutz?
in the Ural somewhere up there, just hanging up there.
Oh my God.
We were all over the world conquering.
Yeah, what most people don't know
Spoils.
about most people don't know about Dylan is an upstate New York boy. He's like, you know, he's
even further upstate than you are.
Yeah, he's
And you're up
further
there.
upstate from
Upstate.
the hick from St.
People from the city think upstate is anything north of like 103rd Street, right? Like
That's correct. That's correct.
I mean, he's as far as you. He's from Lake Placid.
Yeah.
You can't get any further than Lake Placid.
yeah.
I mean, you're basically like you can walk to Canada.
Yep.
So, now Dylan's from definitely a hick town. All right, Mr. Vecchio, what do we got today?
Look, we're wrapping up what's been a very strong month of November here for stocks. Double-digit gain for the Nasdaq, 8% or so for the S&P 500. It's one of the best Novembers that we've seen since the indexes started trading, and so that has many people saying, "Well, this is the Santa Claus rally." You know, that kind of grinds my gears a little bit because when we talk about these seasonal tendencies like a January effect or a sell in May and go away, a real tendency, there's definitions and statistical, studies that support these particular notions. And this isn't technically a Santa Claus rally. And I say that not because of the scope and scale of what we've seen, but it's just not the right time of the year for it, folks. So when I hear on financial media, if it's Bloomberg, if it's CNBC, oh, we're in the Santa Claus rally right now, that's nice marketing, but that's not technically what it is. The Santa Claus rally is this statistical tendency that was first observed in 1972, that in the last 5 days of the trading year and first two of the new one, the markets tend to outperform. S&P 500 has averaged a 0.76% gain in those last first two trading sessions, going back to the start of the index. So when I hear people say we're in the Santa Claus rally now, it's just you need to gently push back against that because what we're seeing in November has no bearing as to what happens in the last few days of the calendar year and the first two of a new one. Now, if January gets off to a good start, we talked about this in Let Me Explain's back earlier this year, there is a statistical tendency for the market to go higher. A 10% gain that you saw in January of this year tends to then compound into a double-digit gain for the rest of the sessions. And sure enough, that's what we've seen here. So, but in terms of how we're looking at December shaping up, I got to tell folks, when we look at how the fourth quarter has performed, it's usually good for stocks. December's not when it's good for stocks. 5 years, 10 years, 15 years, you can go back to 25. The S&P 500, the Nasdaq have both lost ground in the month of December. Volatility tends to expand in the month of December. It's not the dollar that does well, but it's other safe haven assets. Gold does well. Bonds actually have done exceedingly well in the month of December. We're going to have this all out in the seasonality report coming this Friday on the News and Insights blog, as we typically do on the first day of the trading month. But people who are expecting this November momentum to continue into December, perhaps that's the case. Perhaps there's some chase higher here. But cool your jets. The backdrop does not necessarily support it if history is any sort of guide.
Yeah, people have been very generous. They've taken a lot of poetic, a very generous license with what they call the Christmas or the Santa Claus rally. I mean, agreed. But what's funny is that Although I didn't realize the statistics for December haven't been that strong, because as far back as I can remember, December triple witching has always been incredibly strong, which means the third week of December, and you know, the after the third week or after the third Friday, you get this really slow period of time where, you know, it's very hard to sell a dull market, and it doesn't really go down that much. But going into that, you know, third week or that December expiration, that triple witching, it has always been almost 2-to-1 up over down. So that period has been incredibly strong. I'm not saying that over time the net moves haven't broken out about even, because the down moves have been more violent, but the majority of the time the moves have been to the upside. And the majority of time in that third week of the month, there has been pretty significant volatility contraction. Now, we're so low right now, I don't think you can see significant volatility contraction. But when you get volatility contraction along with, you know, buy pressure, you know, it's been a tough month to be short, but there have been cases of some pretty violent down moves. It's just a tough month to be short as a trader.
Well, you mentioned volatility compression around triple witching. That actually sets up an interesting calendar of sorts, because in the second week of December, you're going to have a bunch of macro information coming out, which we've seen has moved markets in recent months. CPI, we effectively wrote off, and then here comes the October report. You get a 5% banger in the Russell after the release. Starting next Friday, December 8th, you're going to have non-farm payrolls. The following Tuesday, December 12th, you're going to have CPI. The Wednesday, you're going to have the Federal Reserve meeting. And so there is an opportunity through that second week of the month for some vol expansion, and then perhaps leading into your triple witching where you get that compression once more. Net on net, we might end up where we are right now with a 12 or a 13 handle in the VIX, but that doesn't preclude the possibility where you see a little bit of a pop, say, into the 15 or 16 along the way. I know some people are looking past the data, they're whistling past the graveyard here. I have been an optimist on the U.S. economy all year long. The middle of the year, when everyone said we were heading towards recession, I was saying things like, check the scoreboard. You know, inflation's down from 9.1% to, you know, in the fives. You're looking at an economy growing at 2.5, 2.6%. The unemployment rate's below 4%. This is the soft landing. I'm a little less optimistic moving forward, quite frankly, because three things have caught my attention that have predated or occurred at the start of every single recession. First off, continuing claims are up 25% over the past year. Every single time we've had a recession in this country, in U.S. history, continuing claims have moved up by at least 25% ahead of that recession. We see that federal tax receipts are down year over year. Well, has the tax code changed? Is the government taking less money out of our pockets? No. So that can only mean one thing. Incomes are down. Business activity is down. That's happened before every single recession. There's only been one time in history where federal tax receipts have turned negative year over year that hasn't predated a recession. And I guess the final thing is the leading economic index. It's been negative for over a year now. The data series doesn't go back that far. And granted, we're only looking at 3 sample sizes here. The recession that we had in 2001, the one, of course, the Great Recession, 2008, and then what happened around COVID. But each time you saw at least 6 months of the leading economic index in negative territory, you've seen a recession play out over the next year. So I know everyone's very happy right now. I know that we're spending a lot of money on the federal government level. A 7% current account, or rather budget deficit is very difficult to produce recessionary conditions, and that may help keep things afloat. But there are seeds of a recession have been planted. And while we could run up the scoreboard here in stocks at the start of this year, it does cater to an environment where maybe 2024 is the year of bonds, where growth expectations are lower, inflation expectations are lower. You get some churn away from some of the big names in the headline indexes. It's less about the Magnificent Seven and the S&P 493, which means a little bit perhaps more vol expansion and opportunity elsewhere outside of the big guys. But 2024, I think, is going to be a little bit more interesting, at least at the start of the year, than people are presuming right now, because everyone seems to think that we're in a Goldilocks, everything is awesome kind of state.
Well, the market would suggest that, you know, knowing, if you're an efficient market theorist, you believe that the market already knows everything that you just said, so the market does believe we're kind of in a Goldilocks thing. But I think it's different. I think it's a little bit, there's a couple things that for 2024 that we can't discount. First of all, most election years are really good trading years. Only
Well, they don't
2020.
upset the apple cart, right?
Well, 2020 did with the pandemic. So 2020 was
Well,
the,
that was an unforeseen.
no, I understand.
Yeah.
The only thing that can mess everything up is kind of something that that nobody has any idea about, or just something that comes out of the blue, like a pandemic in 2020. Other than that, going back to just think about election years for a second. 2016 we were dead. 2012 was not a bad trading year at all. It was good, and 2008 was insane. So we have had some I don't know. We've had certain expectations going into, this mostly reminds me of 2008, because at the end of 2007 to early 2008, everybody said, oh, it's an election year, volatility's low, market looks really strong. And it was all the way up until the summer. And then the summer, all hell broke loose. And it wouldn't surprise me if you have a very long wait until things get a little bit ugly in 2024. Like that.
Well, you're right. The election year performances are quite good. Average performance of stocks during election year is just north of 12%. 20 of the 24 years have provided a positive returns. I say 24 years, going back to 1928 is the data series that I have.
The only difference is, though, that we're starting this year with volatility. Like remember, we started last year with high volatility in the 20s, and the stock market on its butt in 3,800 or wherever it was, 38, 3,900, wherever, I don't remember exactly. But so basically it was poised for something good to happen. Heading into 2024, we have volatility on its absolute butt, down at multi-year lows, and we have a stock market at multi-year highs. So it's a much more difficult starting point. So so any surprise is going to happen to the downside, not to the upside. And everybody's predictions last year were that the stock market was going to be lower, so people were definitely leaning in cash and leaning out of the market. Now everybody's predictions are, the market's going to be higher, and you are battling a much higher risk-free rate, which is challenging from a passive side. So I think you're going to see, I think you're going to see a very different trading year in 2024, but it may not happen early on. Like, January, the full part of it may be that January, February are more of the same, what we've seen in November, December, and that's the hook.
It sets up an interesting scenario akin to what happened at the start of 2022 when vol is on the floor and stock markets are pushing up towards all-time highs. The slight difference, of course, is that 2022 we have the supply shock coming from Russia's invasion of Ukraine, and then the start of the Fed hike cycle. So we've already benchmarked the Russian war in Ukraine. That would have to expand to a country like Estonia or Poland for us to really get jazzed up about it again, at least on the market side. And we're looking on the other side of the Fed hike cycle right now. Powell's speaking this Friday, something that people shouldn't dismiss. Really, anytime a Fed chair speaks, it's worth listening to.
What people have to worry about for next year is not the Fed, or you have to worry about, dysfunctional leadership, potentially even worse dysfunction than we have now. They have to worry about, the people that are running for presidents. I mean, we have a lot of issues next year that we're going to have to face.
Well, I don't think anyone's running for president. These guys are too old to do that. They're walking for president at this point.
I think the most interesting thing about 2024 is I don't think either candidate is going to be running for president. I don't think it's going to be Trump or Biden. I think Trump's going to end up in criminally settling, and I think Biden's going to step away. I mean, he's not going to step away prior. He's going to just say he's not running. And I don't think it's going to be Trump or Biden.
Be good.
We would be so lucky.
Yeah, right.
As America, we would be very lucky. Yes, as a country. And then the market could take off.
What about
next year?
Go ahead.
Go ahead, Tony.
No, does it scare you that they're already talking about a soft landing? Like everything they're talking about, like everything is good.
Well, they should be talking about it now because that's what the
I
market.
know, but as soon as they talk about it, that's when
that's
usually
what
goes
the market
wrong.
is actually telling you.
Right.
Right now, the market is saying, "Hey, if you are looking for fear, you got to go out to 2025 or 2026." Right. To find fear right now. You can't even, you can get vol up to 18 by the end of 2024. And we showed the forward chart.
Yeah.
We showed the forward curve for volatility. It only takes you up to 18, which is like long-term average by the end of 2024. So,
Tony, to to your point about everyone, getting on board with everything is awesome right now, it kind of reminds me what happened over the summer months. You get to the end of July and all these prominent bears, people that you hear in traditional financial media are saying, I'm revising up my S&P 500 target. I was wrong for the first half of the year. You get all this bearish capitulation. And within the week, you see this highs of the year carved out for stocks, and then you get a correction over the next 3 months. So people are wrong in the first half of the year, then they capitulate, turn bullish, and then the market goes down. Look, we've been living through the soft landing. Unemployment rate's below 4%.
Yeah.
The economy is growing at a fast clip. Whether or not that continues moving forward is another story, because the seeds of the recession are starting to sprout. Government's spending a lot of money, though. That's the one thing that makes this very different. I mean, in your GDP equation, C plus I plus G, it's a positive coefficient. It's going to help offset what could be a decline in consumption or overall investment. Whether that's enough spending is another story, and it seems like there are a certain group of people who want to fix the trajectory of the debt in this country. Whether or not they actually have the chance to do so is another story, and what that means for keeping demand afloat is again another question that would need to be answered. It would seem to be negative for GDP overall, but either way, rocky road's probably ahead. We are living through the soft landing. It's been the soft landing the last few months. If you've been treating the market just at the data, not what you think will happen, but what's been in front of you, it's been an environment that has, I think, been easy to capitalize on. But just some dangers may be lurking around the corner. Vol's really low. Everyone's too happy right now. I guess that's what a 10% gain in the NASDAQ in a month does for you.
Yeah, listen, it gives everybody a good feeling towards the end of the year. Hey, this year worked out, one for the good kids.
We had some trials, some tribulations.
Yeah, we were challenged. All right, what else you got?
I think everyone should keep an eye on oil. We talked about this on first call.
When you say keep an eye on oil, why? What are you worried about? You worried about higher oil price or lower?
I'm not really worried about higher oil prices because I'm thinking about how I can get long oil right now. Oil has a ton of volatility. I mean, I'm looking at the NASDAQ right now on the platform, IV rank of 5.6. That's basically as dead as a doornail. But in CLF4 right now, the January expiry for the crude oil contract, 64.7. That's really high. And that is perhaps the juiciest opportunity that you have out there. I was looking over the positioning data that came out from the CFTC's COT report yesterday. It came out yesterday as opposed to Friday because of the holiday. The managed long positions right now are on approach to the lowest levels that we've seen this year, the lowest levels that we saw since oil prices having turned negative in 2020 around the pandemic. Overall positioning in the futures market is quickly slouching back towards its lows of what we saw in June and July, which in turn was the lowest level that we saw since 2011. So this is a very thin market right now. No one is long. People are starting to increase their shorts. Volatility is through the roof. There's an OPEC plus meeting in 2 days' time. There's been some disagreement over the smaller member states as to whether or not they'll cut their quotas or actual production. It's kind of splicing hairs there. But in any event, the table is set for oil prices to surprise to the upside, I think. And if you are a vol seller, this may be the last call before the boat leaves the harbor, because the prices have come off very, very sharply. Growth concerns, recession concerns, obviously there. There's a high correlation between global GDP and demand for oil, naturally. But the short-term environment caters to one which any sort of announcement from OPEC could really draw in the longs again. This is not a crowded trade at all. The longs have been absent. They've been declining. They've been cutting their positioning. It's perhaps the thing that people should be watching most this week, in a week without any significant earnings releases or macro events outside of PCE, but I don't think we really care about that. And then Fed Chair Powell's speech on Friday.
No, we're short strangles in crude oil. It's got one of the highest, IVRs. It's got one of the. I talked about this. I thought I talked about this on Sunday night. We talked about the expected move in oil to January was $8, which was the same as Apple,
right?
And how much more interesting some short premium is in crude oil compared to Apple. I mean, it's like 3 to 1. More capital efficient, more opportunity, and it actually has been working. My crude oil position, which I'm keeping it very delta neutral, has been coming in every single day. So so no complaints there. I agree with you. I think of all the commodities,
and Apple's down to around 7.5. I'm taking a little bit of liberty, and oil staying steady at $8 for expected move.
Yeah, of all the commodities of everything that we're trading, I mean, this is clearly, crude oil's clearly been clearly been the best of anything we're trading.
$75.60 right now. I hate to throw some technicals in there and dare I say fundamentals, although I have a feeling we're going to debate that sometime soon. But it looks like a quintessential bottoming pattern is coming together on short-term time frames. So this is kind of where all three come together for me. When you have that fundamental catalyst like an OPEC plus meeting, when you have a strong technical setup, and then you can look at the cost efficiency of going into the options market with high IVRs, you kind of check the boxes and say, okay, well, this is a trade that, you got to look at the probabilities and say, pot odds, I'll take this one. So for me this week, it's oil. The stocks, all due respect, you've been nice, you've been fun, but you're boring right now. Oil is the place to be.
I completely agree with you with respect that it's probably the best play of all the commodities. It's the best play on the market. I mean, I just looked at I could argue for bonds too, but yeah, I'll go.
Bonds have been working.
Yep.
So we'll just let them do their thing.
Yep, I agree with you. Thank you, Mr. Vecchio. Good stuff today.
Thank you, Mr. Vecchio. We're going to take a quick 90-second break and come back. We got more Tasty Live with a market measure next. Tasty Live.